Welcome to the Investors Trading Academy event of the week. Each week, our staff of analysts and educators tries to provide you with a better understanding of a major market event scheduled during the next week. This week, we'll focus on the European Central Bank meeting scheduled on January 22nd, with an interim meeting on January 7th. The meeting on the 7th will most likely cause market volatility. Normally, we don't focus on a single event, but this meeting will probably be one of the most important events in 2015 and will set the pace of the markets and the euro over the year. The euro tumbled on the first day of trading of 2015 to a multi-year low at 1.2034. The single currency dropped to the weakest level in more than 4 years, and bond yields slid to a record low as investors bet that QE will start as soon as this quarter. The euro was down 0.6%. Mario Draghi gave his strongest signal yet that the European Central Bank is likely to start large-scale government bond purchases by saying he can't rule out deflation in the euro area. The ECB president seldom gives interviews, and his comments to the German newspaper Handelsblatt reflected a drive to win over that nation. Policymakers there have led criticism of quantitative easing, saying it threatens financial stability, reduces the incentive for governments to restructure their economies, and is legally tricky. The risk cannot be entirely excluded, but it is limited, Draghi said when asked if the region could enter a spiral of declining prices, falling wages and postponed spending. We have to act against such risk. We are in technical preparations to adjust the size, speed and compositions of our measures early 2015, should it become necessary to react to a long period of low inflation, he added, stressing that the ECB board was unanimous on the issue. The ECB has already taken several steps short of quantitative easing to try and drive inflation towards the target of 2%, including cutting interest rates to 0.05% and buying covered bonds, which are backed by bundles of loans. However, political opposition to full-blown QE from Germany, which believes the bank has no mandate to buy sovereign bonds, has prevented the ECB following in the footsteps of other nations, including the UK, to flush cash through the economy in this way.